Marcus, good to be chatting with you.
Patrick, good to be here.
I'm sure this probably comes as no surprise to you, but on Livewire, you're consistently one of the best performing authors on the platform.
No, that's no surprise to me, Patrick.
In fact, you're actually the third most followed profile behind yours truly and by Wholesale, of course.
Of course.
I'm curious, what do you think it is about your style that kind of appeals to people? And is there anything in particular that kind of sparked a passion for writing for you?
Tell you the truth, something I did as a kid, which not many people have done, almost none have done, is I did a lot of Shakespeare. I loved Shakespeare. That sounds a stupid thing to say. But I am a writer. If I wasn't writing about the stock market, I would be writing about motorbikes. I wake up in the morning with an empty screen, and I'm a creative. It's a picture that needs painting. I have a passion to do that. Henry, I work with, I know, has a passion to do that. We love it. And I think that comes through in writing, where someone is enjoying being there rather than having to do it because it's work. As for the style, that was developed a long time ago, not a long time ago, but as I moved from institutional broking to retail broking, I realized that the private investor was somewhat uneducated at a time that online broking was just starting. Take control of your own super SMSFs were just getting going, and there was this real appetite for the stock market that hadn't been there before, but nobody really had any education. And out of an institutional background, I knew how the market worked, why it existed, to raise capital, by the way, and realized that the retail investor didn't know what the brokers were up to, why they said buy on BHP, because they want a corporate deal. And I started to educate. So the stock market to me is 99% fluff and marketing and 1% talking to the audience in an honest way, and I just started doing that from the very beginning. My first client was my brother-in-law. I was not going to tell him rubbish, so I just started writing to that style, to the individual, and I wanted to reach out from the screen to them in their desk, in their house, and feel that they had a connection. And our brand now is building a community of better investors. So I don't want to go marketing on you. It's 99% marketing, but that is it. And you've got to make people feel they can trust you and are getting the right advice, not being sold something.
It almost feels like it's gone back in the other direction these days, in that there's so much information out there that it's kind of hard to decide what to listen to and what not to. Which one do you think is harder for investors to, back in the day where finding any information was difficult, or these days where there's so much information, it's about trying to decide what's good information and what's not?
I think you can waste a lot of time reading things that there are a lot of strategists writing articles that won't make you any money, say that, which is fine. It's highbrow stuff, but people enjoy it and they like that and they like talking about it. But if you want to hone it all down, it comes down to one spreadsheet, what stock code you've got, how many shares you hold, whether it's up or down, and what the big number at the bottom is after you've added them all up. That is the only thing that matters to an investor. So I would say, if you want to shorten your investment journey, focus on what you're buying and selling, rather than emailing Marcus about what Janet Yellen thinks, because that isn't going to make the blindest bit of difference to how wealthy you are at the end of when you decide to cash your portfolio in. So focus on the stocks. It's a simple equation.
It's been nearly 40 years now that you've been in this business and investing and around markets. I'm sure you've had experience with more than one market crash in that time. Are there any that really kind of stand out for you, and could you maybe share a story from one of them?
They all stand out, and so 9/11 was an obvious one for me, and I was a broker, and in those days clients had 3 days to pay for their trades. So I had just taken an order for $30,000 in Qantas call warrants off a client I didn't really know that had one thumb. I should have known that, because someone's obviously got to him before, and he decided that these Qantas warrants, of course, what happened to Qantas at 9/11, aeroplane hits a building, the Qantas share price just goes to just collapses. And you're dealing with effectively an option, and it was just out of the money, worth nothing, never going to come back. And this guy disappeared. And this is a great lesson on the stock market. All this clever stuff that's going on always happens in a bull market, and oh, we're wise and we're professional, we know what we're doing. The rubber hits the road when the market periodically has one of its 50% corrections. At this point, it seems to happen, it's once in a lifetime, isn't it? It's actually once every 10 years, and it'll have a tradable 15% to 25% correction every 3 years, and it'll have a 10 to 15% correction that most investors would ignore every year or 2 years or 3 years. So, but the big ones are the ones that count, and the most amazing things will happen that no one's predicted, and everyone will be spending their lives making, all the marketing departments of the fund managers will immediately go into find an excuse mode. But the reality is the market's falling over, and what do? And the most surprising things happen. In broking, people didn't settle their trades, and the individual advisors, myself, was responsible for settling my client's trade, which I had to do after 3 days. And then I went looking for this chap. I remember knocking on his door, and I could hear the shuffling behind the door. It was fine. It actually ended up being a loss of $85,000 at one point, which was fine, except I was only earning $6,000 a month before tax. So it was a seismic event for me. But that's the sort of thing that happens in a crash. It's all the bits. The first thing that happens in a crash for a broker is what's our debtors list. It's about business. It's not about what the stock prices are. Another lesson from it was in the tech boom. I was sitting at Bell's. There was a chap there who'd been a broker forever. Very smart chap, experienced. His clients had a very smooth experience. And he told us it's all going to end in tears. And he was, with the hindsight of the other crashes in his mind, he knew it was all rubbish, much as you might suggest there are other areas of our market at the moment that are all fugazi. They don't exist. And the tech boom was one, and he told his clients, no, it's all going to end in tears. I'm not going to take trades. And of course he was right. But he missed one of the best money-making opportunities in the stock market in decades. And of course, that's the stock market, isn't it? It's a game. It's about making money in the market on any time period, in any stock you can, at any time. It's about making money, not avoiding all risk. And the crash was a fabulous, the tech boom was a fabulous opportunity to make money, make it quickly. And that taught me as well that the most important thing is not necessarily you've got to be involved in the great bits before a crash. They're always the best bits of the market. And those bits feed into the average. The average return of 5.77% per annum for the last 75 years involves all the lunatic bits. And I think with a basic discipline and vigilance, you can avoid the big crashes and still play in the big silly bits. So I learned that the stock market was something to be taken advantage of, not something to be scared of. And you let others lose their heads. That's the best bit.
You spoke there about avoiding those big drawdowns while still, participating in the upside. How do you go about doing that? Are you trying to make predictions, or are you trying to be more reactionary? What's your process for trying to avoid those big drawdowns?
So let's talk to an individual investor. Funds management is different. Fund managers can't respond. You've got an industry fund that's worth 8 billion or the biggest one 100 billion. It can't respond to these even quite large movements in the equity market, and they won't because they've got other asset classes. And the truth is the market fell 35% in the pandemic. The average balanced fund fell about 8% because they've got a spread. So big fund managers don't respond, but we're talking to individual investors. And I feel that they are best served by reacting, not predicting. No, we're not in the prediction game. You will fail if you think the stock market is about knowing what's going to happen in the future. It's about waking up in the morning, having a look what's happened, and reacting to fact rather than fantasy, because no, you can't predict the future. If you look at the GFC, for instance, nobody knew that was happening. Nobody knew what mortgage-backed securities were a cancer in the balance sheets of banks, and it came pretty much out of the blue. So you can't predict these things, but the only time you really need to be unrelaxed is when you get a precipitous moment. I hate to say it because I sound like a broken record, but there are precipitous moments in the market. And we've started a portfolio called the Really Boring Portfolio, which invests in a couple of ETFs, one over the S&P 500 compounding unhedged, and one of them in the ASX 200 compounding. And those are very hard benchmarks to beat when you're a fund manager. So we just have the whole of this portfolio, it's a hypothetical portfolio, whole of this portfolio in those, and occasionally I will do what I would do if I was a very wealthy man and I was part of the, and I was a citizen rather than a fund manager or a stockbroker or a stock market person. I would occasionally sell. And so at the moment with Omicron, I don't want to make this video inappropriate, but Omicron I thought was an excuse. You saw the German market fall 5% in a day. This is not normal stuff. You saw the VIX volatility index spike out of the usual bull market range. These precipitous things happen very quickly, and it's just insurance, and we switch the whole thing into a high interest ETF. So we've got out of the equity market in this really boring portfolio, which is how we communicate strategy calls. And I think that's appropriate occasionally. We are pumped, ready to correct. Sentiment is very positive. Prices are high. US market in particular is trading top end of its very long term, even logarithmic trading range. The market cap of the US stock market relative to US GDPs are way above where it was even in the tech boom. So we're primed for some sort of correction. So I'm currently very sensitive to it. But people would say that it's a big, you can't sell, you can't keep cashing out. This is a couple of ETFs. I'll swap it into another one. We might be back tomorrow when they work out Omicron's irrelevant, and we'll stick it back in. All we did was take an insurance policy out. But I think those precipitous moments are the most important moments for individual investors because they do happen in a calamitous way these days. The herd is so big, it's got such good information, it will move very, very quickly. And just to get out occasionally, try and avoid that 50%, you'll save yourself 10 years of returns.
One of the things that comes up pretty regularly on Livewire is what stock would you buy and hold forever if you had to? I understand you've got a portfolio that kind of focuses on a similar idea. Could you tell us a little bit about that?
Yes, I started something called the we call it I think I might have to rebrand it because it's not getting traction. But we called it the Fufu portfolio, which is FUFU, which is forever. So buying stocks forever. I think I'm going to call it the Forever portfolio. But it's forever unless it F's up. So a Fufu portfolio. So I was looking.
In Australia, that'd take off, right?
I'm sure it will now. But yes, forever stocks unless they go wrong. And it's actually quite it really changed my thinking because normally I would have included, would you include BHP in a forever portfolio?
Oh, it seems a bit cyclical to me.
Absolutely. So if you're going to think about buying a stock forever, I realized that there are headache stocks and there are forever stocks. And there are headache stocks are difficult stocks that need to be traded. It may be long duration trading. They may stay in up cycle for 5 years. But as we've seen, BHP and Rio and Fortescue off over 40% in a very short period of time. These are headache stocks. They're not forever stocks. And they're stocks that I will put in this portfolio because they're too big to ignore. And I think there's a great opportunity. They're on the lowest PEs they've ever been, the highest yields they've ever been. At some point, they're going to turn around. So I'll include them, but they're not genuine forever stocks. Forever stocks are stocks that we have in the newsletter, we use orange charts. This is a silly thing, but we use orange charts for relative performance. So if you see an orange chart in our newsletter, it's showing you the performance relative to the ASX 200. And if you put the top 100 stocks, say, all on one screen with an orange chart, you would very clearly see the forever stocks. They're the stocks that are consistently outperformed, and they're going bottom left to top right under all circumstances. You can do it for 10 years and you will. My son is the best chartist I know. He's 18, he knows nothing about the stock market. But I used to play this game with him on the screen where I would roll a chart forward and say to him, where's that price going now, next? And he would go, duh, it's going up, because it was going up. And then you'd roll the chart forward and see what it did. But if you do the Archie technical analysis, which is stand back, blur your eyes, see where the trend is on relative performance over a long period of time, the forever stocks just jump straight out at you. And clearly one of them is not BHP or Fortescue. But stocks like Aristocrat Leisure, realestate.com, car sales, there are all these, there are a lot of retailers in there, things like Nick Scali, companies that are ploughing a particular furrow pretty much on their own and doing a really good job at it. And the most obvious one to me, if I was to name one stock I think is a forever stock, that would be Macquarie. Because in the US, the competition amongst investment banks is just vicious. Here, if you are a smart, finance-orientated, want to be in the markets graduate, where'd you go and work? Well, there's only one place. You go and work at Macquarie. You don't go and work in a very institutionalized bank. You work in a bank which has got 14,000 of the smartest financial brains in Australia with one goal in mind: make money. And I think that's a pretty good investment. Plus, of course, Macquarie once interviewed me, and I didn't get the job because they must be good. I failed their personality test. Henry passed their personality. I failed their personality test because I was too aggressive and not a team player. And yes, that's pretty much right. And so they wouldn't want me fitting in their team because I'd be pushing at something. So they didn't employ me. That's a sideline. But you have a company that has consistently outperformed. It has got some of the smartest people in Australia. Their goal is exactly what you want it to be, and they've got every single corporate deal, M&A, IPO. If you haven't got Macquarie on your beauty parade, you're an idiot in this country. So they are getting a look at every decent deal in this country. That has to be a good investment. So that's one of my forever stocks.
Do you think that their kind of enduring competitive advantage, which they've demonstrated really for at least 20 years now, do you think that comes from the quality of the people, or is there something else going on there, do you think?
It's surely because they are the only major investment bank in Australia. UBS does a very good job over here in terms of deals, corporate deals, and competing with them. But if every time you sat down in New York to pitch for an IPO or pitch for an M&A, you've got Goldman Sachs over your shoulder with all their bag of tricks, and Morgan Stanley and Citibank. It's a completely different environment over here. They're competing with it's not a level playing field. They have to be on your list, and consequently their business does fabulously. It's got a much higher return on equity than the other banks. It is more cyclical. It does have a much bigger element of sentiment in its share price, so it goes wrong very quickly. The moment the market falls over, Macquarie's a high beta stock, it'll fall more. So we're prepared to sell our forever stock and get it lower down if the precipitous moment happened. You have to understand that. All the good stocks, in the 2018, our own little taper tantrum when the market fell 15%, all the good stocks fell 35, 40%. Got absolutely nailed for holding all the best stocks because they are high beta. There's a large element of sentiment in the share prices. You have to be very careful with them, even though they are great stocks. But if you go back and look at the forever chart 10 years later, you'll see whatever blip it was, it was the best stock to buy at the bottom as well, and they come back as quickly. So the forever stocks, you actually end up with almost all industrials rather than cyclical resources stocks, and you do end up mostly at the big end of town. And I have included some smaller stocks in this portfolio, and within months they're giving me headaches. So forever stocks that aren't headache stocks, and it's a fairly easy list to build. And as I say, we run the portfolio in the newsletter.
You've given us a few clues there as to some of the metrics that you might focus on. Are there any others that you could share with us? Is there a qualitative angle to it as well?
There is. One newsletter was famous for creating this idea of the moat, and that is a very important part of it. When you look down the list, you go, oh yeah, no one else does it as well as them. No one else does it as well as car sales or realestate.com. Nobody else really does it as well as Woolworths and Coles. Everyone's always wondering about which one I should be in. They're both ploughing a furrow there. No one does it. No, Macquarie have got it pretty much not to themselves, but they've got it to themselves. So when you go down, you look at this moat, I suppose you would call it. Other things are the numbers have to be right. You don't outperform for 10 years because you've got a very volatile earnings stream. Generally, you'll find it's backed up by steady progression, a stable but high-ish return on equity. You're talking, if you were talking 5 to 10%, you're probably talking about a utility or infrastructure stock. We're not looking at that. We're looking for 15% plus, and most of them you'll find are in there, if not 45% plus. You look at people like Nick Scali, and their return on equity can be 65% because they're making furniture in what I better not describe their business, but it's a great business.
Very high margin.
Very high marketing. Look at my lovely Italian sofa that cost me nothing, but you're going to pay a lot for it. So some of them are very, very good at their business, and they're not really concerned with dominating the market or other companies. They're just going to keep plowing, much like Marcus today. We just keep putting it out there every day, do a good job, and the growth comes and the performance is stable. Other people in our industry are going up and down. We're just you, and these are the stocks that turn up.
A little bit of holiday fun. It is that time of year. I don't suppose you have a short-term trading idea you'd be willing to share with us, do you?
Look, Patrick, I'll tell you a little secret about the stock market, which isn't a secret to anyone who's in the stock market, but may come as a surprise to some of your watchers or listeners, is a story. My brother-in-law first joined stockbroking back in the mid-90s, and he sat next to an iconic name in the stockbroking industry in Melbourne. And this chap had ignored him until 10 a.m. and he said, come with me, we're going for a coffee. They went for a coffee in Rosati's at the back of 101 Collins Street. And he said, I'm going to teach you how stockbroking works. He goes, what you do is you find a stock that's less than a cent with half an idea. You buy millions of it and spend the rest of your career marketing it. So, and this is how the industry works. So people may not realize that, but when you see a fund manager talking at a conference or writing an article, the micro cap stock you have to own, it's because he holds it. And the job for most fund managers, they're too big to trade stocks. So they send an analyst out for a month on 200 grand a year to have a look at a company, and he does more work than you'll ever do in your life, knows more about it than you ever will know about a stock, and he'll decide to buy it. Now, they're not going to do that so that they can then tell you to buy it so they can sell it. They're doing it because they expect to hold it for 5 or 10 years. But the game after discovering an undiscovered stock is to let everybody else discover it. So you start to tell everybody about it. And so I will tell you about my only PA holding, which is Poseidon Nickel, which has got a fabulous name because it's going to go nuts, no doubt. But it's an electric vehicle play. Nickel is the usage of nickel. Nickel price is still going up. It had a period there where it collapsed and a lot of projects went out of business. Poseidon Nickel, and just to be up front here, the CEO is the godfather to my daughter. And I think he's onto a good thing. He turned a project in Sally Malay. I remember it listing at 20 cents, and he rang me at 14 cents on the first day and said, Marcus, please buy some of these shares. My dad and I are the only ones holding it up. And I didn't buy any. They were 14 cents. They went to $6 because they went from project to producing mine. and Poseidon Nickel are going to do something similar over the next year. There'll be a scoping study out soon, feasibility study done, and they should be back in production next December. And it's that transition that really can transform a share price as well as a stock. So I'll give you that. But it's really a nickel play. There are plenty of other nickel plays out there. They'll all pretty much do the same. And despite the skills of Peter Harrold, the CEO, the truth of the matter is all these stocks have very high correlations with their underlying commodity price anyway. So it really depends on the nickel price continuing to go. So it's a slow burn nickel play.
If you know the CEO, you're going to have to find something out for me. I've always wondered whether Poseidon Nickel was related to the Poseidon Nickel from the 70s that was behind the infamous Poseidon bubble. So next time we catch up, you'll have to tell me, all right?
Yes, well, I will lie and tell you because I hold the shares. It's exactly the same one. It's going to do the same thing. So no, I don't know.
We're coming up to Christmas and New Year's, not too far behind it. A lot of people obviously use this time to kind of pause and reflect on what's happened over the past year and also to look ahead. What's something you think you could have done better over the last 12 months?
That's actually easy. We've got a newsletter business, done fabulously, but we have got a funds management business as well, and we could have performed better. And the lesson over the last year was we did particularly well, your listeners might remember, particularly well in the pandemic, because I picked that precipitous moment and the moment it bottomed as well, absolutely perfectly. And we achieved 20% outperformance in 20 days, but then we underperformed. And we underperformed because I kept cashing out, and also because we were trying to be smart. We did things like, it was a growth portfolio. We thought the banks weren't growth stocks, didn't hold them, they had their re-rating. So we just were being too smart, too clever. And what we've learned over the last year is that the people who run big money in the funds management world are the people who are the most predictable. And the people who are the most predictable are the people that do the least. Might sound silly, but the big industry funds, which are running billions and billions, they're not doing anything radical at any point. They're not taking any major views. And the more views you take, the less money you'll end up running, because the more volatile an experience you will provide people with. So we saw an asset consultant last year saying, how do we do, and they couldn't tell us, oh, we can call, this is how you call a precipitous moment, or this is how you call the banks. They just did not tell us what to buy, when to buy, but they told us how you do funds management and provide a less volatile experience for your investors. And I hope one day you'll come back and find Marcus today running billions, and it won't be because we were super smart, because we were doing things that were a little bit off the wall and we knew more than anybody else, because no one's going to be able to do that over a long period of time. It'll be because we provided a trustable system, process that's repeatable, reliable, explainable, and we will do that over a long period of time and consequently provide our investors with a low risk, low volatility return, which doubtless will be similar to the market. And not try and be too clever. And that's what funds management's all about. I hate to tell you that that's what funds management is all about, because I felt myself hemmed in into averageness by the advice. But it is absolutely clear that you cannot be a cowboy in funds management. Yes, we called a couple of things right early on, but it's long term. It's a long-term business, and you have to provide reliable returns. And that now is our goal. And since we started doing that, we've been outperforming a really quite aggressive benchmark, ASX 300 accumulation index. And it's suddenly come together as, okay, that's what we need to be doing, because our horizon's out there. It's not this month. And that was what I learned last year, was being too short-term clever in funds management is never going to work long-term.
All right, well, now looking forward to next year, what are your biggest expectations, be they stock or sector specific, thematic, macro? What are you looking out for next year?
I'm looking out for, now this is a silly thing to say, I certainly don't want to scare anybody because I don't know, but I do think the big one's coming sometime. Now, it may not be in my lifetime. but the valuations, it may well be it's all justified. In fact, if you look at the PEs of some of these big technology stocks in the US, they've actually gone down. So a lot of this massive rise in the market is justified on earnings. We've entered a period in which technology stocks can reach a global audience, and the growth in share price is backed by earnings, in which case that's absolutely fine. But I can see some of our stocks, one of the charts I look at, I think there's one over there. One of the stocks charts I look at the whole time is the PE, which is a terrible indicator really, but the PE, forward PE compared to history. And you can see that there are some of our industrial stocks that are still way up there compared to where they've been over the last 5-10 years. So I think there is definitely some overvaluation in our market. You probably heard Charlie Munger at the Hearts and Minds thing the other day. There is some overvaluation there. So whilst there's a bull market on, everything's fine. You can just keep tapping away every day, buying and selling things, trying to get things right. But the main decision over the last 20 months, as you know, has not been which stock it's been. Just make sure you're fully invested. And that will remain as long as the market behaves. My biggest focus next year will be maintaining the daily chatter and some good ideas and which are forever stocks, and keep all that going. But as a thematic, it's not about the cycle. It's not about spotting inflation's coming or the interest rates are going up. That's all just daily chatter. At some point, the sentiment legs are going to get taken out of the stock market again. Hopefully not in my lifetime, but the most important service I think you can provide to retail investors at this point is an education about how fickle the market is, an education in what the signs are that will create that moment that is not a disaster. It's a moment of fabulous opportunity to get out and buy stocks lower down and save yourself 10 years of investment returns. And unfortunately, most people will see the daily normal chatter of the strategists and the media and the commentators will just tell them, because these people will do nothing come the correction. They will just tell you it'll be okay in the long term. And I think we can be a bit smarter than that. So my service to our members is I am eyes and ears, looking next year, every day now, looking or trying to spot with what experience I've got and Henry's got and my team's got, to try and spot the precipitous moments rather than ignore them, and try and take advantage of them rather than suffer them, because they will be fabulous opportunities when they come.
One more question for you, a bit of a hypothetical. Next year, you find yourself in a situation where the market has actually fallen 5% over a few days. What will you be looking at to make that decision as to whether you think it's a serious fall that you need to be worried about and take action, or whether it's one that you can maybe not worry about at this time and leave the money on the table?
There is an assumption in your question that it really matters when you sell, that it's a big decision. As per now in our really boring portfolio where we've cashed out of equities to make a point, not to, because this portfolio, by the way, has outperformed incredibly, ridiculously. But just by timing the market, which you could do in a big industry super fund, you just go on your mobile phone, press cash instead of aggressive, So it's just timing the pivot points in the market. The signs are already there in many ways. Valuations, you can look through on stock by stock PE, sentiment's high, PEs are high, valuations are high, where you are in the trading range, how many stocks are overbought. A lot of ingredients are already there. What you've now got to watch for are those moments which are telling you it's happening, and they're not clear. We had one the other day, European markets falling 5%, 4 to 5%, all of them. And that was a sign. So we cashed out. And at the same time, the VIX volatility index, people talk about a lot. I'm not a big fan of that as a predictor, but it's because it's not going to tell you that there's a nuclear thing. It's like a Geiger counter, but it's telling you there's a hell of a lot of radiation. And so that has spiked again. That's always going to spike in a beginning of a correction. So that's another warning, and it did that as well. It really is a gauge of sentiment, and there is no scientific gauge. So I think our coverall is selling isn't that big a deal because we can always buy back in. But a lot of the ingredients were there a week and a half ago, so we cashed out. The trend's still down. There's still a lot of uncertainty. The US market's moving 500 points a night again. I think we've done the right thing. And let's just see what happens, shall we? But if Omicron goes away tomorrow and the market has a big up day, we'll probably think we better get back in. But nobody knows, do they? But some of the signs are there. The other thing to do, of course, read the newsletter. So subscribe to the Markets Today newsletter, Patrick, and then you'll find out what we're thinking about those precipitous moments.
Well, Marcus, thanks for chatting to us today. It was great to hear your insights.
Thanks, Patrick. Pleasure.